the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Hello and welcome to the Business Standard Banking Show, where we bring you the most important updates from the world of Indian banking. In this episode, we look at the health of Indian banks and how they may perform in the March quarter of the financial year 2023. Then, Y. Vishwanatha Gaur, MD and CEO of LIC Housing Finance, joins us for a chat in our Banker's View segment. Our Banking for You segment will tell you how you will likely get crisper notes from ATMs soon. Our consulting editor, Tamal Bandhopadhyay, tells us why this financial year will be challenging for India's banking sector. At the end of the show, we will tell you the results of last week's poll and ask you the question for this week. With healthy growth in loans and a decline in bad loans, banks are expected to show good numbers in the January-March quarter as far as profitability goes. But there could be pockets of concern as well. Manojit Saha brings us the overall picture in our cover story.
Indian banks are likely to report another set of strong numbers when they announce their earnings for the January-March quarter. Loan growth remained healthy during the period, though it came down from a peak of 18% in October to around 15% in the March quarter. Overall profitability of banks is expected to remain healthy amid strong loan growth and recovery and a decline in bad loans.
In the past few quarters, we have seen that the banking results has been pretty stellar nearly on all fronts, be it the loan growth, be it margin, or be it on the book quality. Taking cues from the domestic macro environment and also taking cues from the robust Q4 business update, which a lot of banks have reported, I believe that the momentum in banking results is expected to continue in Q4 as well. Further, the system loan growth in the month of March has been pretty strong. We have observed that over the past 2 to 3 quarters, it is the retail segment which has drove the credit growth. But taking into consideration the government's strong spending in capex, taking into consideration an expectation of a very good Rabi harvest, we expect that in Q4 the growth is expected to be more broad-based.
According to analyst estimates for 17 banks by Bloomberg, the net profit of listed commercial banks is projected to grow 43.6% on a year-on-year basis in the March quarter, on better net interest margins and declining credit costs. Banks are likely to report 21.1% growth in net interest income in the January-March quarter on rising lending rates and a higher yield on advances.
We expect healthy numbers for the banking sector as a whole in fourth quarter. Credit growth, although it has moderated from almost 18% in October to 15%, it is still a healthy number. On the margin fronts, we will see some moderation in the margins because the cost of funds have gone up for the banking sector as a whole. So we will see some margin pressure.
At the same time, the pace of profitability may slow down a bit as there could be some softness in margins and higher operating expenses, with some banks deciding to expand their retail operations. But the Reserve Bank of India's decision of a pause in rate hike may be a positive for banks in terms of loan growth.
The RBI has paused to hike the rate. Now, one might argue that this might have a negative impact on the margins of the bank, which will be the case. But on the flip side, we believe that this is actually good for the banking sector because this would make sure that the momentum in loan growth is also not paused. So we believe this is actually a greater positive than the margins getting impacted. Further, on the asset quality, we don't see any major risk, at least in the medium term. Therefore, the return ratios, be it the ROEs and ROAs, are expected to remain at healthy levels compared to Q3.
On the asset quality front, gross non-performing assets continue their declining trend due to a moderation in slippages and healthy recovery. The resolution of a few stressed accounts is expected to lead to further moderation in gross NPAs, and adequate provision coverage is seen keeping credit costs steady. Some banks may see higher provision requirements as the RBI is asking them to make specific provisioning for top 20 business houses.
For the sector as a whole, we'll see a moderation in the NPA as well. However, the PSU banks could see some kind of an increase in the slippage, whereas the private sector banks will see decline in the slippage. On the provisioning front, because of the lower NPA creation or addition in NPA, we would see a lower provisioning by the bank. However, a recent RBI guideline on the provisions on the top 20 corporates could see a impact on several banks having high exposure to corporate sector. For example, if you see SDFC Bank has almost 14-15% kind of exposure, or the PNB or BOB or Union Bank, they have around 15 to 16%. So these guys will see a higher, they have to provide higher because of this factor. However, the other banks like ICICI, Axis, or SBI has around 10 to 12%, so they will see slightly lower in terms of the provisions.
Another feature of the fourth quarter is that most banks have reported a decline in the share of low-cost deposits. The share of demand deposits, that is current account and saving account or CASA deposits in total, fell to 11.6% by the end of 2022-23, the lowest in 7 years. CASA deposits' share of incremental deposits has fallen to single digit, that is 6.7%, in only the second instance in 10 years. Commercial banks mobilized 15.8 trillion rupees in deposits till the last fortnight of FY23. Of that, demand deposits were only 1.07 trillion rupees, according to RBI data. As interest on fixed deposits has been raised by banks after repo rate increases since May last year, depositors are putting their money in fixed deposits instead of keeping it in current or savings accounts, which offer much lower returns.
As Manojit's report said, there has been a decline in the share of low-cost deposits in most banks. Banks have to be watchful of this. In an exclusive interview with Business Standard's Manojit Saha, Y. Vishwanatha Gaud, the MD and CEO of LIC Housing Finance, talks about the impact of the RBI rate hike on home loans and the projections for the year ahead.
Welcome to the Business Standard Banking Show. Are rising interest rates dampening home loan demand? What kind of home loan growth we would see in the new financial year? To find answer on some of these issues, we today have Y. Vishwanatha Gaur, MD and CEO, LIC Housing Finance. Mr. Gaur, welcome to the show.
Thank you. Thank you.
Let me start by asking you, how has been the business growth in the financial year 22-23, and what are the projections for the financial year 23-24?
For the financial year up to Q3 ending December, we were able to show year on year a very good growth of around 13% in our disbursements. Mostly it was in the retail segment, and this has been there even despite the global economic headwinds, and then it is causing a lot of disruption in various sectors, even though we could show very good in the sense growth rate. I also expect very good demand for real estate to continue in the new financial year also. We are seeing a rise in the new project launches across all the cities, even even in tier 3 towns also. With very good connectivity at the back, the government's strong infra push in the budget and all. So many major infra projects will near their completion, and will surely we'll see a lot of real estate traction in such locations. This will definitely add a lot of buoyancy in terms of demand for homes. And I am sure in the upcoming financial year, will see some very encouraging growth numbers.
In the third quarter, loan disbursement was slightly tepid. Was there a pickup in the fourth quarter?
Yeah, loan disbursements were slightly tepid, we feel, majorly because many borrowers actually what happened, they adopted wait and watch approach to ascertain the how far the rates will move. They want to make it sure. Now I think the situation is more or less stabilized. Right. That's why we're in a position to see that there will be a shift in buyers' preferences, mostly instead of waiting and watch. Now they may, what you call now, slowly start buying. So having said that, the effect of earlier pent-up demand also tapered, now thus leading to a normalized growth rates. If you look at what happened throughout the period, we have been doing activities like very good competitive products and interest rate offerings
Right.
to help and also sustain a very good demand momentum. And we expect these things to translate into very favorable results in the days to come.
For the year for the current financial year, that is 23-24, you said that a lot of projects are being launched. So do you think your share of developer loans in the total loan will increase in this financial year?
What happened actually, the project book, we also earlier it used to be around 7% of our portfolio. Now it has come down, but now we are very selective in our approach.
Okay.
And we are also what you call looking into very what you call important projects where we can think of very good asset quality and then very good demand pickup. And with all these things being the selective approach, there will be slightly what you call no, the build actually the builder's book also will slightly improve. What I feel in the days to come.
The question is the rising interest rates. RBI has increased the interest rate by 250 basis points since May, and there is expectation they will raise it further. So, are rising interest rates impacting, dampening home loan demand in any way? Have you seen any impact on this interest rate increase?
Normally, in this floating rate scenario, it is quite possible whenever the rates go up, EMIs also commensurate with that. And of course, after that, the increase also is happening quite fast and steep. However, what happened, some stability also now expected. What happened as the peak level almost all are nearing. I think post that there could be some reversal in the interest rate, probably the days to come, maybe after some time. But all said and done, despite this, the demand for home loans are almost all stable because the end user segment is now very active. The end user segment is really what we call really a person who is in need of the housing. That demand, actually, that segment demand is very much in place. So, and like I said in the earlier also, with interest rates stabilizing, we will see some very good uptick in home buying in the days to come.
What kind of growth projection you have in mind for the financial year 23-24?
Now, we are very positive that with all the things in place, in the days to come also there will be a good demand, and then we are the good player. Our own brand image is there with very good channel distribution channels across, and very good what you call digitization of our operations, and then we have put a lot of what you call systems in place, and we also spreading through our hub and spokes model, even reaching out to the tier 3 tier 4 areas also, thereby increasing our penetration very well. With all these things, I am very sure that we will have a very good growth rate even in the year to come.
And credit costs also went up sharply in the third quarter to about 1.15% due to increase in the provision of the stage 3 book. Do you think it has normalized in Q4?
Yeah. In the earlier quarter, if you see, of course, it was our own conscious decision to what you call keep robust PCR in tune with the industry levels. So we went up to a good quality. That's why we made provisioning adequately in the Q3. Now coming in the days to come, the asset quality certainly is going to improve. As I already talked to you, our actual recovery system is in full place, and even we are having software to identify the early warning systems and are in place with a very good software and then team working at all levels. I am very sure that in the days to come, asset quality will certainly improve.
Mr. Gaur, thank you very much for speaking to Business Standard. It was a pleasure talking to you.
Thank you.
LIC Housing Finance expects the asset quality to improve in the days to come. And as Mr. Gaur said, the asset liability management position of the company remains strong. Talking about quality, here is a move to improve the quality of notes you get at ATMs. ATMs will soon be loaded through the cassette swap mode, effectively doing away with the current practice of open cash replenishment. So what exactly is a cassette swap and what does it mean for you? This is what we are looking into in our Banking for You segment today. Here's a report by Raghu Mohan.
Starting June 1st, India's ATMs will move to a cassette swap mode of loading cash in a phased manner. Over time, the 4-phased initial rollout across 30 cities will cover the entire network of 250,000 odd ATMs. So what is the cassette swap mode? A cassette swap is a lockable mechanism which is superior to the present practice of open cash replenishment at ATMs. That means personal at cash in transit or CIT firms which move cash to load them into ATMs will no longer have to touch cash. It may not be truly cutting-edge technology, but these cassettes have smart chips embedded in them to store information on the number of notes and denominations besides other things like security codes. Cash is loaded onto cassettes by CITs at the cash center. These cassettes are then transported for loading into ATMs. This process will reduce counterfeits and align the country's cash moving business to global standards. To understand it better, think of this new protocol as pre-packaged tea instead of tea that is bought loose. The changeover to cassette swaps took time and came only after two deadline extensions by the Reserve Bank of India. First, end of March 2022 and then March 2023. This is because banks, CITs and managed service providers failed to arrive at a consensus on its execution and absorption of costs in the ecosystem. Cassette trays cost between 12,000 rupees to 15,000 rupees a piece, and their procurement in huge quantities was seen as a burden. Then there was what is called the interchange. It's the payout by a card issuing bank when you swipe plastic at other banks' ATMs after 5 free transactions. This fee was raised in 2022 to 17 rupees in the first revision since 2012, when it had been reduced from 18 rupees to 15 rupees. If you load the costs of moving cash and the earnings foregone due to the 5 free transactions, the math does not add up. It's still early to say if the interchange will move up. An argument against it is that banks save a lot when they push business from branches to digital modes and into the ATM channel. So, there's no reason for a higher interchange. The flip side, though, is that both the digital and ATM channels are not cheap. In the case of digital, you have to account for investments in technology. For ATMs, it is lease rentals and power charges plus cash loading costs. That said, of the installed base of 250,000 ATMs, nearly 20% are currency recycling machines or CRMs. These not only dispense cash but also allow you to deposit cash. For now, enjoy the whiff and smell of crisp, clean notes. Happy spending!
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
So fewer counterfeits and crisper notes for you. Sounds like a win-win. Today we started the show by talking about banks' performance in the last quarter of the last financial year. But what about the current financial year? I spoke with our consulting editor Tamal Bandhopadhyay on what the new financial year holds for India's banking sector. Here's the chat. Hi Tamal, welcome to Business Standard's banking show. We are starting a new financial year, but before we look forward, let's look back. How was the last year for India's banking sector?
Well, it's been a great year, I would say. After a long time, you see that every quarter the bank profits are going up and up and up. Every quarter is a record profit sort of thing. So, and how did it happen? Because the net interest income was going up and up because we have a 15% and odd credit growth, which is a decadal high. Of course, deposit growth has been lagging, but the banks have been managing it pretty well till now. So very high credit growth. On the interest rate side, yes, the interest rates have gone up. Reserve Bank of India have raised the rate 250 basis point from 4% to 6.5% during the year. But if you look at the bond market, it's not that been impacted. There's not much of that impact. 10-year bond yield, well, it was affected, but not to that extent. So the government could manage well its record borrowing program. Bank did not have to suffer from kind of the so-called mark-to-market losses, too much of it. Of course, the yield curve at the shorter end was much stiffer. They affected more than the 10-year paper. But overall, the banking system has managed well their treasury portfolio in a relative term. Credit portfolio getting better in terms of quality of assets, and also all the banks are mostly well capitalized, and they have done pretty well on the provision side. Their provision coverage ratio, what you call the PCR, has been high, between 80 and 90% for most of the banks. So look at from every angle, the health, profitability, everything. I mean, it could not have been better. I think after a long time, Indian banking system had such a fabulous year.
As I said, we're starting a new financial year. We've just had RBI's monetary policy, where RBI has said this is a pause, not pivot. What are the big challenges that are ahead of our banking sector this financial year?
There are many challenges. I mean, this good time would not continue forever. Challenge number one is on the deposit front. The war will escalate as we end the year. In percentage term, deposit growth is lagging. We can always say that, well, the pile of deposit is far higher than the bank credit, so why do you bother with percentage term? But even in absolute term, deposit growth is far less than the credit growth, which means what we are seeing, the war for deposits will increase. And as the bulk of deposits get repriced, as you know, that the banks get the advantage of repricing the loan quickly, and the entire loan portfolio gets repriced so that they earn higher interest rate. But on the deposits, only the new deposits attract the new rates, not the old deposits. But as we move ahead, I think by the first quarter of the current financial year, 2024, bulk of the deposit portfolio will be repriced, which means their net interest income, the difference between what they charge on the borrowers and what they pay to the depositors, will shrink, which means their net interest income will go down. So that's point number one. Point number two is this, recovery has also played a very critical role in boosting their profit. But the low-hanging fruits have all been plucked. So going forward, the recovery would not be that much. And of course, Reserve Bank of India has said that interest rate, I mean, there's only a temporary halt. We need to wait for the future. It may not be the end of the cycle. Even if, for argument's sake, I say that the possibilities of Reserve Bank of India hiking the rate is not much at this point of time, for argument's sake. But the 250 basis point, what the interest rates have gone up, particularly the retail segment, the borrowers are being hurt. And my understanding is this: there will be new bad asset creation, quote unquote, the slippages, new slippages. What does it mean? The bank's interest income will go down, net interest income, I meant. Banks' recovery will be far less, and banks will have to provide for fresh slippages. So all this will definitely affect their balance sheet, their quality of assets, and their profitability. So the good run, which we had seen, a fabulous run in 2022-23 fiscal year, will not continue.
Now, obviously, you've talked about this before as well, all the global turmoil that we've seen in the banking sector. How concerned are you about the financial sector stability in not near term, but a bit longer view if you take? Of course, you've said inflation is the big challenge, but how does it link to overall financial sector stability as well?
No, I think if you look at the macro scene, we are far better off than many of the developed nations. Yes, inflation continues to remain a big challenge, but if you see our inflation target and the actual inflation, the difference is far lower than what's happening in US and some other markets. So yes, and I hope that RBI does not lose its determination of keeping inflation at 4%. It should not shift the goalpost to 6%. That's one part of it. About the other macro factors, current account deficit, which was a threat earlier, 3 quarters back or 2 quarters back, now as a percentage of GDP, it's now at a tolerable level. So the threat, rupee is not under threat. So these are all macroeconomic parameters which are pretty good. As far as banking sector stability is concerned, I would like to believe at this point we are far better off than other countries. Europe and US, you have seen what happened, and it's different from what happened during the 2008, the Lehman crisis. There's a global impact. This time, even the US and European authorities are more concerned. So they have stepped in early to make sure that the depositors are well protected. Yes, bondholders, the so-called tier 1 bondholders, they had to suffer in case of Credit Suisse. But overall, I think they are managing it well. There's no spillover effect. As far as our banking system is concerned, I think we have some weak points, certainly. I mean, I would not say that every bank is impeccably positioned. They have certain balance sheet. Not everyone's balance sheet is as strong as they should be. Not every bank is as well governed as they should be. There are some pockets of worry, very few pockets of worry. Reserve Bank of India is fully aware of that. But overall, I would not see any collapse in any bank collapse in India.
That is good news. So while the last year has been good, this financial year is fraught with challenges, as you said. Obviously, the financial sector stability is a good news that you don't think that Indian economy is at big risk. Of course, inflation continues to be a big challenge. Thank you, Tamal, for sharing all your insights with us today, and see you next week.
Thank you, Ruchika. Thanks.
So the war on deposits will continue, and as the bulk of deposits gets repriced, banks' interest income will shrink. Tamal also made an important point about the risks of new bad asset creations. Moving on, we asked you last week, should banks give borrowers a chance to defend themselves before declaring them fraud? 81% of our respondents agreed with this Supreme Court direction, while only 19% said no. The National Payments Corporation of India has set the interchange fee at 1.1% for merchant transactions initiated using a prepaid instrument such as mobile wallets on the Unified Payments Interface or UPI network. We are asking you today, should UPI transactions be made chargeable? Our poll is open from Thursday, which is today itself. You can respond on Twitter, Instagram, LinkedIn, Telegram, and our website. We will be back next week with more news and analysis. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.